Welcome back, traders and investors. We have Dean Zayed here. He is CEO of Brookstone Capital Management. Dean, how you doing today?
I am doing fantastic, my friend.
Okay, coming into a quad wedge expiration here. The S&Ps are trading at their highs of the day, 1955.50. Do you have any particular strategies you like to employ on days like this?
Well, on days like this, not really, to be perfectly honest. I mean, we've obviously had a pretty good run here, and I think from the Dow's perspective, I think this may be the sixth up day, which has not happened this year. We're on a 5-day winning streak. So obviously there's some momentum there. In general, uh, we're increasingly in the camp of using some sort of risk management at these levels. Of course, we think the market could go higher and likely will, but it pays to be cautious for folks and for many that don't want to experience a potential 10 or 20% correction. Hedging strategies, a variety of different strategies that we use, is probably a smart idea around these market levels.
Okay, so you like to put risk management in your portfolio. That's always a good idea to, avoid large drawdowns. But of course, if you're, putting on hedging strategies too, and the market continues moving up, you're kind of limiting your profits as well, aren't you?
You are. I mean, there's a cost for protection, and with our end investors and our clients, we of course explain that. I mean, it is about managing expectations, but this is where the discipline comes in to say, I may not want to necessarily chase the benchmarks anymore and try to get all the upside, because if I do that, then I am susceptible to a large loss potentially. So it is a matter of really truly setting expectations. And our philosophy has evolved since 2008. I am increasingly moving away from trying to look at the benchmarks. I know that's the way the industry has trained everybody. We are a bit of disruptors in that sense that, forget about the S&P, forget about how that relates to your own portfolio. What's most important is goals-based planning for you, Mr. Client. And
Right.
here's the way I can put it, when you're 85 years old, Mr. Client, and you've done everything you wanted to do, and your money didn't run out on you because you did a good job, is it really going to matter that 15 years prior you beat the S&P or the S&P beat you by a few points that year? I think the answer we know is no. What really matters is you didn't have a catastrophic minus 40% hypothetically that could have truly impacted your retirement and your financial stability. So that's more of our own philosophy at Brookstone Capital Management. It's not necessarily what the mainstream financial planning community would teach, but we think it's a smarter way to go because chasing benchmarks has proven itself to lead to some disastrous results over time.
So, do you like to use, some of the negatively correlated ETFs to hedge in the portfolio, or do you prefer using option strategies?
We prefer using option strategies, directly buying the options in the client accounts. The way that our business and our investment platform has evolved, we have gone out and essentially partnered with sub-advisors, outside money managers that become strategic partners to Brookstone Capital. And we are, of course, then using their proprietary strategies on our platform for our investment advisor representatives and then ultimately our clients to be able to use and take advantage of. So a lot of our strategic partners use options to hedge, and they have their own particular, trading strategies. We have several that use more of a algorithmic-based tactical strategy, more technical and charting and so on. Sometimes momentum, often using volatility as a key leading indicator from the algorithmic perspective. So that is a different way that we'd still say you're employing risk management. It may not be a direct hedge like an option gives you, but it is a manner or a matter of a form of risk management to, again, ultimately avoid a large drawdown.
Right, and so they're based on. I mean, they're for concentrated stock positions, as well as the overall portfolio that these strategies are based on.
They can be based on concentrated stock portfolios, but more often than not are based on a more diversified ETF-based portfolio. So many of our strategists now are just simply using ETFs to get your underlying exposure to whatever market or sector or industry that you seek, and then overlaying on top of that either an option strategy or some sort of tactical overlay that might, allow us to shift that ETF portfolio into other ETFs or even into cash at times.
Okay, and so you could use to sell calls, obviously, to for some enhancement of your portfolio. But probably the kind of protection that you're talking about is probably just puts on the issues that you have in the portfolio. The only problem with that is that you have the erode of the time premium. So, yeah, are you going out longer term on these options and perhaps putting some spreads on, or are you just rolling, keeping them on a monthly or quarterly basis and just rolling them over?
Well, I'll give you one specific example of
Okay.
a strategy that we manage in which we essentially will buy a 2-year put on the S&P.
Mm-hmm.
So we're going to go out 2 years at the money put. That's our protection, of course. And we know that there's a cost for that, and the time decay works against you. But if you look at the time decay, roughly at about a year, roughly speaking, you'll see a huge decay from year 1 to 2. So to answer the question, it's a great question, is we will have a 2-year put on, but we will manage that annually so that we will sell it at what we think is an opportune time before there's a massive amount of decay. So that allows us to get as much out of that, and then we'll re-hedge it, of course. We'll always hedge in this particular strategy and go out another 2 years. Having said that, along the way, this particular strategy does engage in the monthly selling of puts and calls on the S&P, and that is a way to you could either spin it as we're going to generate additional premium every month, small amounts to help pay for that long-term put, or it's just really going to just help with the overall total return of the strategy. However you want to slice it, we're not just going out long 2 years with the put and sitting on it. That's going to be managed
Okay.
with the time decay element in place, and we're going to try to enhance the overall returns by engaging in some monthly trades as well.
And I see that you also perhaps will recommend structured products such as notes and CDs that have predefined return risk parameters. Now, last time I went to the bank, there certainly weren't any CDs there worth. There was no risk or no reward. What are these products that you're looking at, and what kind of return are you finding, and also the risks associated with it?
Well, that's a great question. So let's start with the notes if we can. A structured note is simply a bond issued by some of the larger banks out there, all the big names that we would know of. So for one, clients have to understand that they're taking on the creditor or default risk of the issuer, in this case, the issuing bank. So that's a risk, of course. Lehman Brothers always comes to mind.
Yep.
If you think a company like Wells Fargo or J.P. Morgan or Goldman Sachs is too big to fail, or Morgan Stanley, right? That's up to you and the investor, but that is a risk. So you're buying the bond. But the key is, with the bond or the note structure is, unlike the traditional structure that says, I'll pay you, 3% a year for the next 5 years, and if you hold your bond to maturity, you'll get your money back, barring a default event. These are indexed or structured in a way that says, I'll pay you X if Y happens. I'll give you 6% a year as long as the S&P 500 does not go down below 70% of its initial value. Now, I just made that up. That's an example, but that's the way many of these are structured. So the interest can be higher, but it's going to be contingent on an event. Hence, it's called a structured note. The same type of format exists in some CDs. Of course, the benefit there is you get the FDIC insurance. They're going to be a bit less competitive than notes because there's a cost to have that FDIC. And I will say this to all of our listeners, there are literally thousands of different crediting methods or formulas that are used when creating these types of structured products, whether it's in the chassis of a note or a CD. But in all instances, they're doing that financial creativity and engineering behind the scenes and then packaging it for the investor in the chassis of either a note or a CD. So it's similar to the strategy we talked about where we're actually buying options and hedging. It's just a more convenient way for some investors to say, hey, that note looks good because it's easy. I know what I'm going to make. I know what my maximum losses are. And I know that I'm okay taking on the creditor risk of XYZ Bank. So it is an emerging area in the financial product world that I would absolutely say people ought to keep an eye out because it is a multiple billion-dollar part of our business that is growing.
Okay. All right. And you stressed diversification, across, I guess not only across sectors, but using different risk management strategies. Would just looking at things on a historical basis here. Are you at like some of the highest cash levels that that you've been at in a long time?
We are not actually. We're just about fully invested in all of our strategies, frankly. So there's nothing on our radar screen right now across all of these multiple strategies and sub-advisor partners that is flashing major correction or bear market. So at this point, it's very, very bullish, frankly.
Really? Okay. All right. And so you're not so for your clients. I guess it all depends on the individual client. Are you using ETFs in your strategies? Are you picking individual equities, or does it just depend on the client?
Well, the best way to answer that, we've talked about a couple of different strategies here already, just in general. So we have over 35
Wow.
strategies that we manage. And so the best answer to that is some of them use ETFs, some use mutual funds, some use individual stocks and bonds. Ultimately, we customize the blend of those strategies for each client. So they might own some that have stocks, bonds, ETFs. The key is, and this is a core to our personal philosophy at Brookstone Capital, is we will blend or diversify a client across multiple strategies. So you might own a hedged equity strategy side by side with a tactical strategy that focuses on volatility as their indicator, side by side with maybe a portfolio of structured notes as an example. So in our world, diversification is not just a traditional asset allocation across asset classes like large cap value and big cap growth. It's more across different strategies, each of which has a set of rules on its own that could be fully diversified on its own. But when blended together, that's where we've had some fantastic results.
And so, what can derail this bull market here? I mean, I guess interest rates going up. I guess that the street was not satisfied with Janet Yellen's testimony or her move on Wednesday. They kind of think she's being a little bit light on inflation, and you had that unbelievable move in gold yesterday. What can finally derail this bull market?
Well, I think the Fed is the big one, of course, unwinding what they've been doing with QE, and then the effects of that, with the Fed's balance sheet. I think we're still in sort of this science experiment that they've engaged in, and they've used multiple creative strategies, and I'm not so sure the ultimate resolution of that is a good one. So that is a big one, the Fed and what they do over the next couple of years. And I'd say number two, of course, is everyone's talking about the bond bubble and interest rates, and I think that could be an issue if we had a spike in rates unexpectedly, which we don't anticipate. But those are two major issues. If you were to really press me, I would say China is another one out there that their growth and their numbers and their lack of transparency can be an issue, and that could be one that sneaks up behind you, and you wake up and there's some headline stories that just surprise the markets, to the downside. So keep an eye out for China as well, I'd say.
Yeah, I mean, there's been things going on, in Ukraine and Iraq and whatnot, and just seems that the market just doesn't really care, and no matter what goes on over there, it just comes in, and the buy to dippers are prevailing. So, well, Dean, thanks a lot for coming on. We've had Dean Zayed. He is CEO of Brookstone Capital Management. He is stressing the importance of some level of risk management in your portfolio. Avoid that big drawdown and still try and capture some of the upside. So I think that's great strategies for people who employ. Dean, thanks for coming on and giving us your take on the market.
It's been a pleasure. Thank you very much.